Good morning, ladies and gentlemen. Thank you. Thank you so much for joining the Cinnabar quarterly session, the first one of 2025. And by all accounts, this was meant to be a boring quarter. In fact, when we started planning the quarter for this presentation, we didn't have the presentation in mind that we are now going to be showing you. But as you're no doubt aware, this year is anything but boring. There is a lot going on. And on the back of that, we decided to bring back one of our regular speakers, who is Frans Cronje, to take us through what's happening in the world. So my name is Alex Cook. I'm the CEO of Cinnabar Investment Management. And what I'd like to do is take us through what the agenda is going to look like today. So if we can roll on, Cam, who's driving the presentation for me, to the next slide. I'll give us a brief business update, and from there we'll jump straight into market review and investment insight, where Cam's going to be taking us on a journey of what's happened. Then Frans is going to be telling us about what's happening within the GNU, what his firm's thoughts are on what's happening in the world, particularly Trump, the trade wars, the war in Ukraine. And then we're going to be looking at a deep dive into actual portfolio construction. So we've got all this complexity happening. And what we thought we'd do is take you under the hood and show you what's happening on a regular basis within the Cinnabar team and how we look at constructing portfolios. There's going to be a Q&A session at the end. We've left a long time for Q&As. Within the screen that you can see, there's a Q&A button. As we go through the presentation, please pop as many questions through as you would like to. We're going to see if we can address each and every one of them. I know that there are a lot of questions that came through on the chat before the presentation in the sign up. So we're going to be addressing those questions as far as we can as well. So to roll us onto the next slide, Cam. And I'd like to start off with our purpose. And this is crucial. Our purpose is just this: to create and protect intergenerational wealth. And what this really speaks to is that we're responsible to construct portfolios that don't blow up the ship. So as a person that's generating intergenerational wealth for both myself and for other individuals, I never want to come back and find a bad surprise. Markets are going to go down and they're going to go up. But on the whole, I'm looking for very predictable performance for people that we look after and for my family. And that's what we're aiming to do, to generate predictable performance. And we're driven and guided by our core values, where the first one is that we invest our effort for value. So we like putting effort into things that give us reward. We always encourage each other to challenge but never be disagreeable. In fact, we have a score where we rate ourselves on a quarterly basis as to what the friction is within the team. Now, we don't want a frictionless environment. If we get to a frictionless environment, it means we're probably not challenging enough. So we're conscious of that, but we aim to never be disagreeable. We look to make things simple wherever we can. We've got an absolute hunger for growth. And then one of the most important values is that there's no large company that owns us. We are able to approach our investments completely independently. So let's say if we're using Coronation, if Coronation is not performing for whatever reason, we are freely able to fire Coronation and hire another fund manager. If Coronation owned us, then it'd be very, very difficult to do. So we're always looking to reduce those conflicts of interest where we can approach investments completely independently. As far as the business update goes, I would like to just hammer home on one thing, and that is that I believe that we have probably the strongest investment committee in the country. So we're very lucky to have exceptionally strong people. Internally, we have myself, we have Jeff Blount, who has a CFA, Cameron Hewson, who is a CFA, Carl, who has BSc Honours in Actuarial Science. Then the external contributors are Brandon Zeetzman, who's got a CFA and a KAYA, which is for alternative investments, Tumi, who is a chartered accountant, and then Becky, who's got a CFA, CFP, and is BCom Honours. And I'd like to welcome a new member a new member to our investment committee, and that is Adam Belkin. We're very, very fortunate to welcome Adam to our team. Adam is a doyen in the investment space within South Africa. He's an admitted attorney. He then spent a lot of time at Alexander Forbes, spearheading their alternative investment strategy, where after he went across to Sanlam, and he really headed up global portfolio construction and looked after an enormous amount of money there. And we're lucky that Adam's able to join our team. So Adam, I hope you're listening. Welcome. It's great to have you with us. You've already added tremendous value to us and to each one of our clients. So with that said, I'd like to hand over to you, Cam, to take us on a whistle-stop tour of trade wars, real wars, and the investor's dilemma. Over to you.
Thank you, Alex. Yeah, welcome, Adam, as well. I'm sure those who haven't had the pleasure of meeting him yet will have that at some point, and I think he knows a hell of a lot. So very, very grateful to have him being brought into the team. But like Alex said, a lot's happening at the moment. I think the best way to describe and how to intro this section is to say that to invest in the current market is like playing Jenga, unfortunately playing Jenga during the middle of an earthquake. There's been so much that's happened around the world. Like we've mentioned, trade wars out of the US, real wars, Middle East, Ukraine. Even locally, we've got the GNU, where there's a few cracks that are starting to show. And I'm sure we all started the year hoping for a lot of positive news, a lot of stability, something that's a little bit more predictable. But what's kind of transpired is less so. We're back in a stage of load shedding now again. I know it's been paused, but it's still not great to have that again. Some of the cracks are coming through with regards to the GNU, and then Trump and his ongoing belief in tariffs and how it's been on again, off again, and how that's kind of been driving markets. So I think with all that said, let's start by diving into what are the three things that are influencing markets currently. And the first one is no surprise. It is US-China relations and then Trump's tariff policy as well. And I thought it best to kind of show how this has almost been like a tit-for-tat approach between China and the US. So starting from Trump's inauguration on the 20th of January, he then was very quick to implement some new tariffs on Chinese imports, so 20% imports. China said, okay, that's nice. We're gonna match you. We're gonna impose some tariffs only 3 days later. It then took a little bit of time to settle, a little back and forth, what's going to happen next. And so 3rd of March, US doubles down, increases tariffs again. China, who would have guessed it, goes and continues the counter tariffs. So, and then followed up by filing a World Trade Organization complaints as well on the back of this. But what this does is, obviously it looks like a bit of a game, but what it actually does is it makes it a lot harder for businesses to plan effectively, because they're not sure how much their goods are going to cost, what the exact relationship is going to be between the importers and the exporters. And it means that it disrupts global supply chains. All of this just adds to the level of market volatility that we see. And it's not just China that's facing the pressures, and leads us on to our next section, which is that in a surprising turn of events, Donald Trump said that he might be considering sanctions against Russia. The goal of this being to help get Russia and Ukraine around a table so that they can start discussing how they can come about a ceasefire. And what's important here, and I think arguably the most important part, and shows quite a bit into Trump's strategy, is that he's using tariffs to not only protect America and make sure that America grows, but what he's doing is he's using tariffs as a mechanism to stop having to send or to not need to send American citizens onto the front line in the form of support during the war. So it's a little bit different. He's now using tariffs instead of sacrificing lives. So potentially showing a different mechanism in which he can use to end the war. And then on the back of this, markets have responded a little bit carefully, because now specifically with regards to energy, if there's any more sanctions on Ukrainian exports, it's going to mean that prices are going to go up a little bit, which will be quite inflationary. But also, there's a real possibility that the EU now have to be completely isolated and have to protect themselves. for the past decades, US and the EU have had a deal through NATO that they're going to protect each other. But there's now the situation where the US is not going to be supporting them. And so on the back of that, we've seen a couple of the defense stocks surging into the market position. So while the Ukraine war is still continuing at the moment with no ceasefire right around the bend, there has been a positive development in the Middle East. So there's been a new ceasefire round of talks that have happened, and we're now verging on just over a month of having a ceasefire. And so it's showing that there's a bit of a temporary relief in something that's been quite a volatile situation. After months of ongoing conflict, it looks like finally Hamas and Israel are willing to engage on peace talks that might be a little bit more structured than they have previously been. So markets as a whole welcome the peace talks, and we see that in the price of oil, as we see how it's dropped down. But analysts are cautioning that if these tensions do end up picking up again, these gains could quickly be erased. But the hope is that this isn't just a temporary relief, that the worst is far behind us now, and that it's not just a pause in long-term conflict. So it's clear that over the past year and a bit, that geopolitical risks have been one of the biggest influences on markets. But it's important to factor in the fundamentals. How is inflation looking? How are interest rates looking? And this also plays a big part on the growth we see going forward. So I'm sure a lot of you are tired of hearing about inflation. It's been over the past 2 years. I think that's been one of the buzzwords. But first it was too high, then we saw it coming down, and now it's just refusing to go away. And so the question is, are we finally in the clear, or is it something that is going to stick around for a little bit longer? Well, that's where it's a little bit complicated. Inflation, as you can see, is nowhere near the highs it was back in 2022. It has started dropping down. But as it started to drop down, Donald Trump decided to implement some tariffs. And tariffs, as a general rule, are quite inflationary. What they do is they make it more expensive for American consumers and businesses to import from overseas markets. So what this does is makes the overseas products more expensive, meaning that the US consumer is going to have to buy a more expensive product, even if they went to a local producer. And on the back of that, you're going to see a little bit more inflation. So the Federal Reserve has to balance the amount of inflation that Trump's going to cause to make sure that they aren't cutting rates too soon and letting inflation kind of go out of hand. But it's not just the US specifically where inflation has been tapering. We see across the globe, there are pockets of inflation that are still quite high. But for the most part, there's been a little bit of a cooling down. But it's not been an equal recovery. We see in the UK specifically, there's been a temporary bump up in inflation to 3%, up from 2.5%. But the Bank of England policymakers don't see it as being much of a long-term trend, and they expect this to naturally ease. The Eurozone is actually having a period of deflation. So they have the inflation fell to 2.4%, continuing its steady decline from having double-digit numbers just in 2022. But China, on the other hand, is a different picture. So instead of using interest rate cuts and monetary policy to bring down inflation, China's actually trying to increase the level of inflation. So their target is at 2% for 2025, which is the lowest it's been in decades. But it's showing that China is really struggling to revive its sluggish economy that has been struggling to grow, and the weak consumer demand on the back of that. But the divergence between what's happening in China, what's happening in Eurozone, UK, and USA shows that the global economic recovery has not been a linear one. It's not been a case where all regions are recovering at the same rate, and brings into question just broadly diversifying. You can't have a blanket approach to investing globally. You need to make sure that you have targeted bets, but still maintaining a overall portfolio that will be able to catch the upswings when these markets start to turn. But what all of this highlights is that if we've learned anything over the past years, past 5-10 years, it's that volatility will always remain. And As a result of that, we look at what is called the VIX. So the VIX, or another name for it, is the fear index. This shows us just what the level of fear is that is present in the market. And it's not necessarily the number that's too important here, but it's more to speak to the level of increase. So year to date, it's up just under a third now. So it's up 30%. And what they're saying is that investors are getting a lot more anxious. And as a result, they expect a lot more ups and a lot more downs. This is kind of supported by what we look at gold. So gold is also known as a safety haven when markets are feeling a little bit anxious, when investors think that there's a little bit more political uncertainty it's going to happen. They start rushing towards gold as being the safety haven asset. And this is pushed up now to just shy of $3,000 per ounce. So there's a lot of uncertainty that's playing in the gold market and a lot of unknowns. And that case is kind of similar for South Africa, where it's all been around the GNU and the level of economic confidence within our country. And so I think best is if we just start with the GNU and review how they've performed by breaking down the two main roles that the GNU are responsible for. The first is, can they reduce the unemployment? How to do that? And then can they grow the economy? So we'll start with the first one there, and we'll look at the level of unemployment in the country. And it's quite positive. The story is nice. It's first quarter 2022, we've seen a decline. It picked up again early Q2. But as the GNU took over, we've seen a marginal decrease from 33.5 to 31.9. So this is really good. There's been a few of the initiatives that the government have implemented, like Operation Vulindlela, as well as the Economic Recovery and Reconstruction Plan, showing that some of the initiatives that the government are implementing are making a difference. But you need to factor in that we are still at incredibly high levels. So we currently find ourselves at 31.9%, which is the fourth highest unemployment rate in the world. So in order to bring down unemployment to a manageable level and back in line with global consensus, there needs to be something else. It can't just be initiatives. And so that leads me on to the second point, which is they need to drive growth. We see that growth for the most part has been positive. Last quarter, we're up 0.6% after a slight contraction in Q3. But growth is only the growth of South Africa is only at around just below 1%. In order to achieve any real changes with regards to unemployment and to push the economy forward, we need to be growing at around 5%. So it's not enough to just be implementing these policies. There needs to be a real investment into better infrastructure. There needs to be more bold policies and some serious structural reforms in order for South Africa to generate the kind of growth it needs in order to bring down the unemployment rate. Businesses paint kind of a similar picture, but while I leave this on, it could be a little bit deceptive. Currently, we're seeing business confidence levels at around 45. So 45 appears quite good on the basis that it's the highest level it's been since 2022. But where it's interesting is that if you look at how this index is calculated, it's made out of 5 general sectors: new vehicle dealers, retail, building contractors, wholesalers, and manufacturing. And this is meant to measure, it's based on a survey, it's meant to measure just how optimistic businesses are feeling at the moment. And what we can see is that 4 out of the 5 sectors went down. The only sector that pushed up a significant amount was new vehicle dealers, interestingly enough. So the main reason for why new vehicle dealers saw the surge was there's a lot more sales volumes. That's been mostly attributed to the withdrawals of the two-pot retirement system, lowering of the interest rates, but then also this massive inflow of Indian and Chinese cars that have flooded the market, coming in. I mean, almost a third of the price is what you would get for your European brands. And so that's pushed new vehicle sales up quite a lot. And you can see that investors were potentially feeling, consumers were potentially feeling a little bit more confident with regards to spending money on their new vehicles. The story is still the same when we look at consumer confidence. So consumer confidence index here has been negative for a long time, since early 2019. but it's been trending upwards for the most part. We got to -6% as of the latest reading. But what the newest forecast says, it's going to be around -8%. So things like lower interest rates, lower inflation, and the reduced use of load shedding are helping. But what this shows us is that South African consumers are still feeling the pinch. And if the budget speech, which is supposed to be tomorrow, Frans will tell us a little more on whether that's still going to go ahead. But if that budget speech does announce VAT increases, you're going to see more strain being put on a country and a consumer base that's already feeling a lot of pressure at the moment. We see this same kind of volatility and the risk in how much the rand has been moving. A year ago, we were at 19.10 on the back of the GNU, some optimism. We see it dropping down to just above 17. Then we start the rate cutting cycle. Donald Trump takes aim at South Africa, specifically with regards to the Land Expropriation Act. We see the rand start to weaken again, all the way back to 1909. So the same point we were almost a year ago. We've seen some strengthening again on the back of this, as there's mostly due to the dollar becoming a little bit weaker, but also hope that a Ukraine-Russia peace talk can actually come to fruition, seeing a little bit more of a risk off sentiment there, and people going into emerging markets as well. So the GNU has been helpful for the most part over the short term about market performance, but it's about generating long-term changes. And that's where I think the biggest stumbling block so far has been for the GNU. I think have a look at how this has influenced market performance. So often you see in markets, they kind of turn a blind eye to a lot of the news that's happening, even some of the economic indicators. And it's not to say that necessarily if a stock was cheap that it would perform well. It's kind of been ignored for the most part. And we see that looking over a 10-year period, developed markets have significantly outperformed emerging markets. And it's just become wider and wider ever since the COVID crash. The emerging markets were predominantly brought down by the Chinese and the Japanese stocks. But the key takeaway is that if you've been invested anywhere other than America, you have severely underperformed. And so as an investor, if I were to look back, and I'm sure a lot of the clients or yourselves in particular as well would see, okay, if I'm going to invest now, I'm going to go to the best performing region over the past 10 years. I mean, why would I not look at the performance? But we roll forward the picture to what's happened so far this year, and we see a shift in the narrative. We're seeing specifically EM outperforming DM, developed markets, and emerging markets. We see the S&P 500 with underperformance. And so this number was at the end of last week, but as of yesterday, the US markets as a whole had their worst trading day this year. The NASDAQ, which is the tech sector companies in the US as well, had its worst drop since 2022. So there's a lot of a kind of a shift in market sentiment, and then a market that's for very long been underappreciated, even though it's been quite cheap. The FTSE has seen huge amounts of expansion, and it highlights that although you can't ever predict when a market's going to turn, it's important to make sure that your portfolio is always set up in a way that it catches these uprises. And so South Africa has also led the pack, despite some of the negativity that's been centered around South Africa. If we look at the performance relative to emerging markets, I mean, it's a significant outperformance there. Even if we start comparing ourselves to the golden child, the S&P 500, we're looking at over 7% outperformance. This is in dollar terms as well over the past year. So there's a lot of optimism around South Africa, and it just shows that because we were cheap, it meant that at some point that was going to reverse. And so to make rapid changes to move to overseas, we got a lot of pressure from that from investors. But we knew that the markets will eventually return to what we call fair value, and we'll see this kind of outperformance. And so I'll show you again later at the end of the presentation, but performance has really benefited from this. And it just shows to stick to the plan and make sure that your portfolios are built to diversify some of the risk, but also to catch the upside gains. This year, we've seen that it's been more resources that have driven the market. So I showed you earlier the price of gold, but there's been in general, quite a commodity boom as we get into a period of expansion again, hopefully with lower interest rates. We've seen that resources have pulled up the South African market. Year to date, we're up 19%. Quarter, we're up 14%. But what's interesting is the market has largely been driven by industrials and financials over the past couple of years, past 5 years, and that trend has reversed. And again, highlights why if you're going to just discount resources in your portfolio, you're not going to catch these upswings at the moment, and you're going to start being fairly flat during periods where there's some kind of economic change. And so with that, I've got 3 key takeaways. Currently, the world feels very much like it's upside down. There's so much tension and anxiety relating to markets at the moment. We've got the trade wars, you've got real wars that are going on. The GNU being in a bit of a state of disarray, business confidence being a little bit misleading, and then the consumer also struggling a lot. So there's a lot of market volatility at the moment, and it's really impacting the growth. And so it leads on to our second point, that markets bounce back when you least expect it. So FTSE has for the long time been undervalued but didn't rebound, and there was no real logic behind that. But as soon as you discount them, that's when they tend to outperform. And so you need to make sure that your portfolio is able to catch the upsides, but also at the same time make sure it's protected on the downsides. And so the most important point is that robust portfolio construction process is going to be essential. There's always going to be some level of uncertainty. There's always going to be political drama and economic surprises that you can't predict. And so you need to make sure that you have a portfolio construction process that is robust. And what we say often is that you don't always have to guess who the winner will be. You just have to be prepared for the outcome either way. So with that in mind, I'd like to introduce you to a familiar face, Mr. Frans Cronje, who will be giving us an insight into the GNU and Trump as well. So I'm looking forward to that. So Frans, over to you, sir.
Cameron, thank you very much. Let me just share with you, and then I'll get you guys underway. You should be seeing the big blue flower. That's about to turn into that. You see the union buildings. And what I'm going to do for you in the next 45 minutes or so is to take you through our assessment of what is happening in the country now, the status of the GNU, the outlook for its economy and its relations with the rest of the world. We'll close with that, and America and AGOA and the like. So let's start over here. It's cause and effect in South Africa. This is the rule by which the country is structured. 1994, we start all the way down there, and we go out to 2023. And the first thing I show you is a political indicator, the share of all protest actions in the country that are violent. And early on in democracy, that's about 15%. And then about a decade in, that comes down to by half, it's about 7%. And subsequently, it's increased very quickly, and it's gone to 30%. And you'll see later that this runs precisely in line with the ANC's own showing in elections. On top of that, the share of all households in the country that do not have electricity as a marker of sort of basic standards of living. On day one as a democracy, that's 49%, just more than a decade in. ANC's brought that down to 19%. Life is getting better. And in the subsequent period, let's say the decade and a bit to today, this indicator flat lines, and it's perfectly representative of broader living standards. You'll see a GDP per capita and jobs and all sorts of things later on this morning, and the pattern in each case is the same. Third indicator, there it is, GDP per capita. Early days of democracy, the Asian crisis in '98 holds us back a bit, but as that washes out of the world between around, let's say, early 2000s and around 2008, we have the sharp lift in basic living standards. And all political behavior in the country, the support of the ANC, the same will attach to the future of the GNU, runs on the material circumstances of people. If those improve, the country calms and stabilizes. If those deteriorate, the country becomes more volatile. Into the GNU, just a reminder of the point we've made several times in the run-up to the GNU, to the election last year and afterwards. It is a popular deal. This question was asked before the election last year. The DA and the ANC both have some good people and some good policies, and if they could learn to work together, that is the best thing that could happen in the country. Agreeing with that was 61% of black voters, disagreeing a third, so that's split 2-1 in favor of agreeing, and amongst white voters, essentially the same thing as well. This is not a deal that the parties had to drag their reluctant supporters into. This is a popular deal. It's always been the most popular political deal in the country. A step beyond that, we go to the morning of the election to make another point on the deal, and it is its structure. What is it actually? Well, this is on the day of the election where parties got their support from. So the ANC, that's in blue, it got about 5% of its support down here from suburbs, the middle classes, the established middle classes, 40% from the periphery of urban areas, the aspirant middle class, and 40% from traditional rural areas. And what the ANC understood in going into the GNU is that if it tries to double down on its rural market, it's going nowhere politically in the country, because that market is diminishing, the size of it, at the mortality rate and the immigration rate. And to remain relevant in South African politics, let alone to have a shot at one day restoring its majority, ANC needs to retain the confidence of the aspirant middle class on the country's urban fringe. Here the DA, and on election day, and its support, and it's a very different picture. It gets more than half its votes from the established middle classes. It's a little bit from CBDs. And then it gets about 15% from that same aspirant middle class on the urban fringe. And at some level, this is, of course, a coalition government, lots of a real unity government, lots of partners. It's also just a deal between the ANC and the DA, but deeper than that, and more importantly, it's a deal between these guys, the aspirant middle classes in suburbia, the established middle classes in suburbia, and the aspirant middle classes on the urban fringe. And that is good, because it means interests of the major partners to the GNU are essentially aligned. Policies are advantageous to the established middle class or advantageous to the aspirant middle class. There's no other South African deal that could have achieved the same thing. So the deal is popular, number one. Secondly, the structure of the deal is very solid. It has long-term prospects. There's some of the other parties, but we can get into them later if you want to. Now, what do people think after the fact? Is the GNU performing well? At 100 days into the GNU, 58% of voters thought it was performing well. That's come off 10 points in the second 100 days, 200 days. But those thinking it's not performing well are a small minority still. The initial split was 3-1 in favor of the GNU at 100 days. Now the split's essentially 2-1 in favor of the GNU at 100 days. We think there's still a very strong trend in favor of the GNU. Cameron made the point of what happens when the economy doesn't grow very quickly. And our sense is that should the GNU not be able to kick the South African economy into a 2 to 3% growth band, confidence in the GNU is going to continue to deteriorate over time. Next up, and this really opens a door to what to expect in that event. Before the election, before the GNU was established, these two questions were put to voters. The first was that the ANC must remain in power, or there will be chaos and anarchy in the country and everything will fall apart. And a second related question, as it turned out, was the DA would look to bring back apartheid if it was ever put in a position influence in a national South African government. Now, who agreed and disagreed? Of ANC voters, we were only looking at ANC voters here, 60%, or 59%, said there would be chaos and anarchy if the ANC lost its majority. And 67%, 7 in 10, said the DA would certainly do everything in its power to restore a system of apartheid. The no's were 30%. These figures split 2-1, really, against the ANC dropping out of power and against the DA coming into power. These were very important factors that retained ANC voters within that party. What has happened, you might even go as far as to say the ANC makes, in some respects, a strategic mistake in letting the DA into the government, because 200 days in, it's apparent that there is no more chaos and pandemonium than on a normal day of the week in the country. Things haven't fallen apart and deteriorated into a new level of anarchy. And at the same time, there's very little indication that the DA is trying to restore apartheid. And so two of the key factors that retained ANC voters in the ANC have now been diluted. And the consequences of that are quite spectacular. This is turnout model party standing. So this is the votes that parties would get in an election if an election were held at this particular juncture. So juncture number one is obviously the election itself. In May of last year, the ANC got 40% and the DA got 22%, and the EFF and MK got 9 and 14. 100 days into the GNU, things had changed dramatically, but watch out, in 200 days they're going to change even more dramatically. There was that initial surge of confidence. This was the great reform moment. The ANC had finally realized, it demonstrated its realization of the need for reform by agreeing to have the DA in the government. And within the ANC ranks, their support was back on its way to 50%. The DA was up a little bit as well. And the parties outside of the GNU, they were losing support because the GNU is so popular, and being outside of the GNU is not. But 200 days in, as ANC voters realize that there is no great reform movement on its way, and that they have, in a sense, been led to a reform horizon that isn't there, they have reversed their positions. And at 200 days, we had the ANC at 32%, the DA continuing to lift a bit, and the radicals on, well, in this case, the right of the chart, left of the political spectrum. Now, one thing you'll notice when you look at this chart, if you add the February 25 numbers up, you're not getting to 100%. And that is right. And the reason for that is this. When we poll for an election, we ask people, of course, which party do you intend to vote for? And we pay some attention to the answer they give us. But that's not actually the best question to ask them in terms of what they're actually going to do on election day. In addition to that direct voter preference question, we ask a battery of related questions about your perceptions of the direction of the country, the leaders of your party, how you feel towards the party, etc. And through a long experience, we're able to use that battery to assign you as a voter to a party. You need to pass a certain threshold on that battery of questions for us to assign you as a party voter. And then we think, and this is right, on that battery, we know who you will vote for before you know who you will vote for. What has happened in the February 2025 polling is that the share of voters that can pass that threshold to be assigned to a particular party has diminished dramatically, more than we've ever seen it before. And that is that the source of that is former ANC voters who, realizing that the reform is not imminent, that chaos and anarchy has not descended, that the DA is not driving apartheid, have become actual free agents in our political system, a phenomena we haven't seen to this extent at any point in the last 30 years. And if you explore this idea a bit further, where it may be headed, is that into future if the growth rate remains disappointing, into future elections, the DA is going to start making its way towards 30%. I don't think it's going to get there, but it's making its way towards that. And the ANC from 40 is making its way towards 30%. It's not going to get there either. And but they'll be that approaching the 30% point, the two parties, is perhaps now the trajectory that we're on. And we'll get to the implications of that. Another thing we've seen that we've never really seen before to the same extent, is all post-GNU, is this. So here's a question. If the DA called a motion of no confidence in Mr. Ramaphosa, you could do that in Parliament, and the motion would pass because the EFF and MK would support it, and then Mr. Ramaphosa would have to resign, and so would his government. That would be the end of his career. If the DA did this, would you support it or oppose it? Now, supporting it amongst ANC voters, they're the ones in sort of gold over here, only 25%, this is of the remaining 32% of people who would vote for the ANC, of voters, would support, and 72% would oppose, because these are the people who believe in the ANC. Amongst DA voters, 67% would support the motion of no confidence, and just a third would oppose it. And amongst black voters, this is what I want to show you, it splits evenly. And the point I want to make is this: we've never seen this to this extent before. The opinion of black voters is now on many questions fundamentally different to the opinion of ANC voters. Now, these things used to be pretty closely aligned. If an ANC voter had a view, you could assume black voters held the same view, and vice versa. That has split. And the import of this is immense in terms of understanding that drift of the ANC arguably now down towards 30 and the DA arguably up towards 30, in the absence of reforms that kick the country's economic growth rate into a much higher gear. On the question of Eskom, this is the data of the past 4 or 5 years or so. The energy availability factor, that's what share of Eskom plant and equipment is working. On 2 occasions, actually a third, that flirted with going under 50%. Mr. De Ruyter is then removed. The new Eskom management takes charge, makes very sensible decisions, including reversing some of the green focus and supporting coal station managers. The figure goes up to 70%. Don't worry that it seems to have fallen to 57. This is seasonal. And you should compare this 57 to that 48 over there. Maintenance has not been abandoned in order to make this possible. Maintenance rates have been fairly what they should be for the nature of the fleet. Breakdowns of plant and equipment have significantly reduced, but there is a little bit of a reversal. I'm about to get to this question of reversal now, and other questions. The way to understand the position now is that the dire mess that was inherited out of the De Ruyter era has been fixed, and that's been done by lending proper support to the coal station managers. And as a consequence of that, load shedding for a period abated. However, not enough has been done beyond that to refit defunct coal fleets to put the country in a position where it is out of risk of load shedding. So, for example, last Friday evening, at 6 p.m., maximum demand for electricity was 28,000 megawatts. And we were essentially in stage 1 and a bit, stage 2 load shedding. And the reason for that was that despite the pump storage facilities firing, so they were working, despite the private and Eskom gas turbines that burn diesel, they were working. Despite the coal fleet performing to a relatively strong level, there were about 21,000 megawatts. The wind was blowing, about 1,000 megawatts. Kuiberg was out of action, though you lose between 1,000 and 900 and 1,800 megawatts, we were in stage 2. So we're now in a position where a single failure of a core piece of plant and equipment, the nuclear generators at Coburg, are sufficient to, at peak hours, take us into stage 1, stage 2 load shedding again. Over the weekend, when we were in stage 3, that was unnecessary. We didn't have to be in load shedding because the gas turbines weren't burning diesel. And that's a call that's made on the cost of diesel. So to understand this, I just want to recap this, it's very important. We have recovered from the disaster of the Dorota era, but not sufficient new coal plant has been refurbished to take us out of the risk of load shedding. And at a peak hour, on a peak day, if a single generating unit fails, we're now at risk of the low stages of load shedding. And where Eskom is averse to burning diesel, paying for it, then we can be at stage 2 and stage 3 load shedding. The political importance, remember this point I'm making is the ANC is perhaps making its way towards 30 and the DA for approaching 30 from the other side. This is ANC voters as load shedding cause you to reconsider support for the ANC. And it's a major driver of getting ANC voters to rethink. And I held a small seminar last week for a group of ANC leaders, and I told them they're completely mad not to burn diesel. Just from your narrow political perspective at this time, you're going to suffer further diminishing electoral support as a consequence. Cameron dealt a bit with confidence, and SA, it's a natural lead on from what I've said about Eskom. Here's the 30-year data, business confidence, off in the little dotted line like the ants, and consumer confidence. And the point to make is that between around, let's say, 2003 and 2008, both lift in unison. Consumer confidence, interest rates have come way off. The number of people in employment has almost doubled. We've rolled out this massive social welfare net. And business confidence is lifting very strongly. And the combined effect is that the country's economic growth rate, not shown on the chart, will break through 4 and later maintain an average of 5%. Subsequently, there's the global financial crisis. There's the era of Mr. Zuma. It's not great. And these little worms are fighting valiantly to get back up again. But these little valiant fights leave the worms way off levels that we would need to see to think that the economy is being kicked into a high growth gear again. The reason for that is that South Africa's fixed investment level is just far too low to think about a growth rate of much over 1 and a bit % of GDP. Here's fixed investment data since the 1960s. So general government investment in the economy, public corporation investment, and to make here, if we just take the democratic era, that starts over here, is the initial lifts in government investment are reversed into the present. We're going to still get to the budget as the fiscal thing starts to bite. Private investment. Look how, you remember from the previous chart, I showed you how confidence had lifted between really the early 2000s and 2008. Look what that did to private investment. Subsequently flatlines for reasons from Eskom to Eskom's a primary reason for that. And I've made the point to you, we don't now have sufficient new plant and equipment to enable much additional fixed investment. Stay with the theme of it. Here's economic growth in South Africa since the 1970s. Here's the democratic period. There's the Asian crisis, 98. It's the beginning of the recovery. The recovery continues. 5% growth between 2004 and 7. There's the rather disappointing position into the present. And there's fixed investment as a share of GDP. It's collapsing out of the volatility of the late 70s and 80s. It begins to recover. Asian crisis hits it. It recovers from that, and then it's on a very positive trajectory. It's almost approaching 25% of GDP, which is where it should be for the economy to grow at 4% plus. but we lose our way. There's a little bit of a recovery after COVID, but we're at 15% fixed investment as a share of GDP. That's perfectly consistent with an economic growth rate of around 1%, grow at 4%. We need to take that up to 25%, close a 10 percentage point gap, and hold on to that idea. So when I talk to you about the Americans towards the end, I'm going to show you it's probably the easiest way to do that. In the absence of raising fixed investment, the country remains volatile. Here's GDP per capita, which obviously flows directly from GDP growth that you saw on the previous chart, red against fixed investment. So GDP per capita growing very strongly in that sort of early 2000s to 2008 period, stagnates and dips a bit. And off the right-hand axis, violent protests as a share of all protests in the country, which I told you earlier feeds directly into ANC support levels. And this is a useful chart to think about the GNU, because if the GNU is unable to replicate the performance of this era over here in terms of growth and incomes and jobs and the like, then it will ultimately suffer the same fate as what the ANC has suffered in surrendering its support. Just to make that point a fifth time probably, on this chart, the orange line is ANC support in national elections. So 63% in 94, and then there's a national election. They go up in 99. Go up in 2004, they get to almost 70%. And they do that as the protest intensity is off the right-hand axis. As the protest intensity is cut in half, 15% of protests being violent down to 7%. And then as GDP falters, I've made the point, I think, sufficiently, protests are up, ANC supports down, expect the same kind of effect attached to the GNU in the fullness of time. And yeah, well, almost for a sixth time. I see the chaps put in another one of these charts. It's a number of people with jobs, 1994 to 2024, red against the violent protest line. And you can see as job growth almost doubles from around 8 million in 94 to about almost 15 million people going to work in 2008. The country's calmed. And subsequently, as job growth stagnates, amazingly, going into Mr. Ramaphosa's era, an equivalent number of people going to work, as was the case. Thabo Mbeki packed up his office in the union buildings. Make one more point on that theme, because this is going to be central to the outlook for the success of the GNU. Number of people employed in the country, off the left-hand axis, the data you've just seen. And then the average number of net new jobs created per annum through the presidential eras of each person, and later the GNU that's governed the country. So through the years of Mr. Mandela and Mr. Mbeki, South Africa is generating per annum about 500,000 net new jobs per year. Mr. Zuma will cut that in half. He'll do about 250,000. And Mr. Ramaphosa will struggle to hold the number at just over 50,000, which is why his party lost an election. The extent of the problem is quite incredible when you compare it to global norms. This is the tertiary unemployment rate, the people who've qualified at a university, about 15%. That's the national rate at about 30, and then the height for the rate for high school graduates, so it's about 30. World's rate going into last year was about 5%, high income, upper middle, lower middle income economies and the like. And there's a warning here that the extent to which a degree of complacency settles into the GNU is very dangerous. If that complacency starts to make the case that a 1-2% growth rate even is adequate, these chaps in the new government need to haul ass to get that growth rate up to 2 to 3 and later 4%, to head off the longer-term consequences for the country of this extraordinary rate of unemployment. Go to the budget, which we may hear tomorrow. As of yesterday evening, there was not yet an agreement, so I can't tell you that you will hear the budget, but I can show you, if you saw it, what it would look like. Start with 30 years of data. The orange line is the budget deficit, the difference between what the government spends and what it earns, and the ANC, coming out of Soviet exile, 13 years into government, racks up the first sustained surpluses since the formation of the Union. And at the same time, they cut debt to GDP in half to do that. And the saving on the government's interest bill, by cutting its debt bill in half, was redirected to financing the rollout of the social grants program. A very different second half of the democratic era follows. It is allowed to escalate sharply. The deficit deepens. I know not to, by global standards, do anything too alarming, but you must read the deficit against the growth rate. When your deficit is a multiple of your growth rate, you're in some real trouble. Into the present, despite the strong prospects of losing an election, the ANC puts the brakes on spending and makes significant cuts in practice. If you read the statistical annexures of the budget, you've been reading about those in the data for a couple of years. What has happened over the past several weeks is that immense pressure has been applied to the finance minister from the ANC to say that curb the cuts. And as a consequence, we get into this VAT hike territory. And that provided an opportunity to the opposition, which was itself under greater pressure for being soft on the ANC in the minds of many of its supporters early in the early days of the GNU, to start taking a hard line. And hence we sit with the deadlock that we are presently in a second time. If you'd seen the budget a few weeks ago, and if we see it tomorrow, it will look something like this. Government revenue as a share of GDP has lifted over the past 30 years from around 20% to a level between 25 and 30%. Implication is the idea that the state can spend more effectively than the private sector. Revenue is pursuing an expenditure line that is out of hand. This is that little here where I've drawn the circle. This is the end of the first half of the era after 94, where pragmatic ANC fiscal management brings about the surplus. But expenditure is now sitting at about 30 to 33% of GDP. The point of diminishing returns in terms of taxation on the country's economy is probably sitting somewhere down here at about 24-25%. So we're almost 10 percentage points past the point of diminishing returns in terms of further taxation. And yet the minister has been put under such incredible pressure from within his own party and elements of it to drive that taxation as the fear takes hold, that the support that's diminishing for the ANC is that the rout is going to persist into future elections. If you, let me just get to these little dotted lines. Those little dotted lines are what you would have seen had the 2% VAT hike gone through when they first attempted to deliver the budget a few weeks ago. The trouble for the ANC is that tax hikes are very unpopular, even within its own base. I'm showing you all voters here. Middle-class people need to pay more tax. Do you agree? Only 1 in 5 believes that, and a good 6 or 7 out of 10, approaching 8 out of 10, disagree with that, including in the ANC's base. And it's commonplace now to find the ANC driving policy positions that are opposed by the remaining core of its own voter base. And that would extend, I might show you the data later, I think it's in the show, to questions such as expropriation, for example, which is unpopular within that base. And the point here, I suppose, is that as you think about the future of the ANC, it's that support dipping towards 30%. This VAT business that it's driving. If you were an opposition leader, you couldn't come up with a better campaign to further damage the ANC's electoral standing. Stay with the question of taxation. This is where it all comes from, government revenue, so customs, duties, other revenue. VAT does about a quarter, corporate income tax approaching 20%, but personal income tax is 40%. Stay with that. Individual income tax payers and what they earn. So there are about 5 million, let's say 5.5 million taxpayers who pay tax on earnings of less than 500,000 Rand a year. There are about 1 million taxpayers who pay tax on earnings of 500 to 750, and the 861,000 taxpayers who pay tax on earnings of 750,000 or more. So collectively, we're approaching 6 or 7 million taxpayers. There are about 25 million welfare grants being paid every month, ratio of 1 to 4. But go beyond that, the share of all income tax received, the 6 million, 5.5 million that pay tax on earnings of less than 500,000 a year, they're paying 40%. The chaps in the middle are paying 10%. But almost half of all income tax is being paid by 861,000 people. Now, these are the same people who run the companies that pay the corporate tax and therefore make possible the economic activity that create VAT receipts. So the tax base is essentially in the hands of less than 1 million highly skilled and highly mobile individuals. Expropriation is here. Beware of this bill. It has very little to do with land reform. It allows the seizure of, or the act now allows the seizure of any fixed or movable property without compensation, the consequence of which will be to further depress the fixed investment rate. But it's not a policy that's popular with voters or ANC voters. So here's some questions on it. 200 days into the GNU. The ANC can be trusted to expropriate property. Only a third of voters agreed with that, and really only a third of the ANC's voters. It's a good idea, expropriation without compensation, the same data, and it will not harm investment or confidence, only a third. And again, time and again, like this VAT thing, this business, we see an increasingly worried ANC taking strategic decisions that are not going to enable its political recovery. Turn to the rest of the world, and then I'm done for you. Start with the question of AGOA. That's South Africa's total exports in billions of rands. These are the golden bars. Exports to the United States in total, and then AGOA exports. Now, if you export under AGOA, AGOA is obviously very important to you. But if you do not, in the broader macro sense, AGOA is not that important. Whether it was cancelled or not would have no real effect on South Africa's macroeconomic performance. However, for the Americans, South Africa is more important than I think some of their posturing has suggested. You're looking at a map here that I drew myself. My colleagues say I should have it professionally done. And what you're looking at is a triangle. There's the triangle. And the triangle covers the Indo-Pacific. More than half of global trade that travels by sea moves within this region, and 80% of China's oil. On the eastern fringe of the Indo-Pacific are the Solomon Islands. The Imperial Japanese understood their importance after they sunk the American fleet at Pearl Harbor in 1941. They seized and held the islands in order to cut off Southeast Asia and Australia from the protection of the United States. 8,000 miles to the west is Djibouti. The US used to have a sole naval installation there. Now there is also a Chinese one challenging the US for hegemony into the gateway to the Red Sea and the Suez Canal beyond that. And later in the course of the year, just over here, I'll make a little dot, you will hear that Russia has a naval facility on the way. The third X on the corners of this triangle is the naval base at Simonstown. It guards the Southern Sea route. It's one of the 3 X's that command control of the Indo-Pacific. The US under pressure on 2 of those X's already. If they lose the third, they're in some trouble. More so for the fact that Trump's abiding foreign policy objective is a zone of hegemonic US influence in the Western Hemisphere. So there, well, it's a basic. Hence he goes on about Greenland. You can enter the Western Hemisphere from Greenland, and Canada the same, and the Panama Canal the same. But the back door into the Atlantic is the naval base at Simonstown. And if South Africa fails or falls into the hands of Western adversaries, that naval facility will provide China with its only feasible route to operate in the Atlantic. So there is a strategic argument. Another argument to make on America's position towards South Africa is that it is behind the curve on fixed investment into Africa relative to China. And there's a chart that demonstrates that. The point I want to make to you is that there are serious national security people in the US and elsewhere who believe that it's extremely important that the US and the West in a greater sense has strong relations with South Africa. They will make the point that it is pointless to attempt such relations in an environment where the South African economy grows at just 1%, because then the country may at some point be overrun by populism and anarchy. Western investment will have proved to be futile in trying to shore up an African partner. But if an effort can be made to get the South Africans to back off on the most destructive policies, that the ones most responsible for deterring fixed investment, expropriation is one, and a tax in capital on arrival another, a point that Mr. Musk has made several times, then there is the prospect of doing a deal with the South Africans. And that deal could help the US, if it was focused around Southern Africa, catch up on the fixed investment gap that's opened between it and China on the African continent. And if you do the maths on what kind of numbers you're talking about there, within a decade, what the US needs to put into Africa in order to catch up with China, if that was focused on Southern Africa, that in and of itself would be sufficient to raise South Africa's fixed investment rate from 15% to nearer 25%, and therefore to make possible the 4% growth that would lock in a stable future for the GNU, or even see the ANC go back above 50%, and see South Africa become a useful Western partner covering a very important strategic location, which the West is vulnerable at the moment. I will stop for you here at this point, and I go back to my hosts who take over again. We'll ask questions in a couple of minutes. Thank you very much.
Frans, that was fantastic. What I think we should do is maybe get to a couple of questions now, if you don't mind, and then there are lots of questions in the chat that have come up already, and then we'll have Cameron's section, and then we'll circle back and get to as many of the questions as we can. So Cam, I'm sure you are listening. I know you're listening, but if you can get through your section relatively quickly, because just so we can deal with as many of these questions as possible, that would be amazing. So I'm just trying to bring up these questions. All right. So the first question, it really speaks to more of Trump's policies and its impact on South Africa. The first one is about the withdrawal of the US aid and what effect that has on the US on our economy, in terms of an increase in taxes to fund HIV meds and so on. So curious to hear your view on that.
Yeah, look, I quite understand that American taxpayers might demand to have their money back. And if that's the case, the question really is not what are they thinking, but how was the situation allowed to arise where South Africa was unable to finance critical medical and related services to its own citizens. Yes, this obviously creates a further funding gap and puts further pressure on the Treasury. But the broader point must be that if you are an economy that grows at 1%, an emerging market that's been growing for a decade at the quarter of the rate of your peers, then when events occur, they become crises like this has. If you are an economy that's growing at 4% and has been for the last 10 years or 20, 30 years, it should have been the case for us, this would be no trouble at all. And we'd easily be able to finance our own projects. There's also, which makes the ANC's pursuit of this VAT business all the more peculiar, an enormous amount of wastage within the fiscus. I've seen estimates that up to a quarter of state spending is essentially wasted or stolen, which means that if that was an end was put to that, we would run the country's finances on a massive surplus. So I think it's perfectly, if the Americans withdraw their money, the correct answer is to say to them, thank you very much for the years that you put it in. We understand completely. The problem is not you. The problem is what's happening here.
Yeah, it leads us to another good question, which relates back to what the US is doing to cut their expenditure. They're obviously in a massive hole. They're technically insolvent, and Musk and Trump are looking to fix that. Wow. What do you think the mechanism is that they're following to try and fix that?
Well, I think it's obviously very aggressive, and it's born of confidence, which I think is absolutely well-founded, that enormous wastage of expenditure was taking place in and around the US, and that much of that expenditure was often at odds with America's strategic interests. And the driver behind this, I think, is to create a hyper lean and competitive American economy that does not leak funds into projects that pursue ideas that are at odds with America's best interests. And what do I mean? One view would be that the extent to which American taxpayers' funds have been used to drive green energy has created an internal American lobby which served to undermine the competitiveness of its economy. At the same time that its key rivals, China for one, was continuing to pursue the most effective energy sources that it could. And a good Chinese friend of mine who says, of course you go to the climate conference, of course you sign the agreement. He says, but you don't do it when you get home. and both America had been doing that, and China had been not. And South Africa is a strange emerging market that actually tried to do it. Yeah. So I think what they
might still destroy Europe as well.
Well, yeah, you're going to see this competitiveness gap open now between the US and Europe. The point is, what I believe those guys are after is the creation of a hyper-competitive America. Just on the South African point again, what they've said three things on South Africa. Number one, stop actions that threaten US national security. They haven't said that about India, for example, which is a BRICS partner. So there's something specific there that needs to be addressed. The second thing they've said is, despite the hue and cry here about Mr. Trump and Mr. Musk, is don't undermine property rights, because you'll never draw the fixed investment you need to get your growth rate up to 4%, and then you're not an option for us, but you're going to fail. And this expropriation business, as I said earlier, it applies to any fixed or movable property. And I know a target of this to be pension funds in the fullness of time. That with the fiscus under pressure, expropriation legislation would allow the state to place pressure on pension funds and tap those deep pools of capital to continue expenditure at levels that aren't possible anymore through the national budget. The third point Trump and Musk has made is exempt foreign investors from BE, because it's a tax on capital on arrival, makes us your country fundamentally not competitive. I have a much more generous interpretation of their intent towards South Africa, which is to create external pressure on the South Africans to embrace key reforms that are necessary conditions to getting our growth rate out of the 1% rut and up to around 4%. If we're prepared to make those reforms, I have a very strong sense that the reciprocal sort of response from the US will be a trade and investment deal of a scale that single-handedly will be possible to take our economic growth rate up to 4%.
Well, they want us to succeed, but does it look like we're going to acquiesce to some of their requests?
I don't know, not at the moment. Pressure breeds reform, always. It's a fallacy of the end of history idea that took hold of the Western world at the end of the Cold War, that liberal democracy inevitably spreads everywhere, and so we can just be nice to each other. These guys believe in hard power diplomacy. So diplomacy backed by hard power and deterrence. This is the philosophy that they will execute around the world. I think it could be successful in many respects, and that's the philosophy they're going to apply here. And if the South Africans aren't willing to acquiesce, as Mr. Zelensky's now done, China to an extent has asked to do, what's going to happen is they'll look for fallback positions. I said about the importance of Southern Africa and the naval base at Simonstown. Well, if you don't have Simonstown, you have two alternatives. One is Walvis Bay, Namibia. Namibia is looking really strong. It's a kind of fundamentally free and open. They cheated in their last election, but not too terribly. It doesn't have any radicalism. It's flat. The climate's nice, etc.
Alternatives, in other words.
And it's got oil. And the other alternative beyond Walvis Bay is Lobito in Angola. The Angolans are hosting the US-Africa Business Summit this year, not South Africa. Get on well with the Americans. So I did make the point that the Americans are under some pressure in the region not to surrender the Southern Sea route. But if the South Africans are going to be difficult about this, then the Americans have well-established fallback positions in both Namibia and Angola to mitigate the damage of losing Simonstown.
Last question before we move on to Cam, and that's your thoughts on the dollar as the reserve currency of the world. Being the reserve currency of the world is obviously it's an onerous job for any country to have, because all commodities outside of your country are still bought and sold in dollars, which means there's a massive demand for your currency, and it inflates the value of your currency and makes your exports very, very expensive to the rest of the world, even though your country's getting very little benefit, besides maybe the purchase of bonds. So what are your thoughts on that?
I don't think we're at a point yet where there is a feasible alternative to the dollar. I think Mr. Trump wishes for a weak dollar. There's some analysts who say, of course, well, that's at odds with his tariff policy, but I would just want to get that point. And I don't think Trump is a tariff guy. I think he's a free trader. And I think that some of the strength that we've seen come off the dollar in the last 2 weeks or so is a consequence of a bit of thinking that these tariffs are not an economic mechanism at all. They're exactly as you guys said earlier. They're an alternative to sending young Americans to their deaths in wars around the world. And they will be used in order to force diplomatic concessions, which you might otherwise do through military force. And beyond that, they have very little appeal and might dissipate faster and sooner than some analysts think. If that's the case, the inflationary effect of them is diluted. The rates in America could come off somewhat. The dollar come off as a consequence. Emerging market currencies strengthen. But I don't think we're at a point yet where even if the Americans would entertain the discussion, which they probably would, on the advantages otherwise of reserve currency, that there is a viable alternative in the reasonably foreseeable future.
Yeah, agreed. Frans, thanks for that. There's so many more questions, so please stay on the line, and if we can hand over to you with all this complexity happening, the dollar losing value, trade wars, real wars. How do we put together portfolios?
Thank you. Yeah. So like Alex mentioned, even in the intro, we just want to give a little look under the hood as to how we go about building robust portfolios. So to say diversification is one thing, but to actually diversify just for the sake of it has no value. You've got to be able to make sure that you take bets in areas where you are more likely to win than you are to lose. And so I think we'll go down in terms of almost like a funnel on how we construct our portfolios to visualize it. And we'll use a case study. So we'll be looking at the Global Balanced Fund as a kind of the proxy for this. But how we start is the most broadest way you can start in terms of how you're going to diversify is based on asset allocation. So broad asset allocation, simple enough: equity, fixed income, cash, money market. Your exposure to each of these asset classes depends largely on either your risk profile or your risk tolerance. But if you want to achieve quite a bit of growth over inflation, you invest more into the equities. You accept that you're going to have more volatility, but for the most part, you're going to look to outperform over the longer term. If you're more of a conservative investor, you prefer the safety of cash, money market instruments, and fixed income, where you're not going to be expecting too much drops, but at the same time, you give up some of the potential upside. And so you're looking at just marginally outperforming inflation. So what we do is we diversify across asset classes, though. So the global balance for your moderate investor, you're looking at having equity, achieve some outperformance, but also providing some downside protection through fixed income, cash and money markets, so that if markets turn and we see big sell-offs like we've seen over the past couple of days, particularly in the US, you have some support that maintain a smoother trajectory so that you're not being completely exposed to the market movements. And so we go beyond that, we start looking at regions. So now that you know, okay, this is how much how much equity I need, this is how much fixed income I need, you need to start deciding where to allocate. And so when we talk about region exposure, we talk about, okay, what is our baseline? If we were to say we have no significant view, we don't think US is better, we don't think Asia is bad. If you were to just say, okay, what is the baseline? What is the starting point? We use the All Country World Index. So this is an index, put simply, just all stock markets across the world. How much do they share in the total value of global stock markets? And so we see most of it is comprised in North America. There's no surprise there. America by itself makes up a significant portion of, well, a majority portion of the total stock market. And what we do is we make sure that we aren't taking any significant overweight bets here. So you'll see there'll be partial ones here, but nothing significant. And why we do this is we believe that it is our managers that we employ, it's their responsibility to be able to extract value out of these regions. We don't want to take massive risks, because taking a massive bet in a specific area, what this does is it exposes you to region risk. And in the case of what's happening in the Middle East, or what's happening in Ukraine, Europe, America, as soon as you have that, you're taking a massive bet. And if the market as a whole goes down, or goes down, you expose a lot of the portfolio to that. So we use this as the baseline for regional exposure. We then go a step lower and focus on sector allocation. So this is what it looks like in terms of our global equity. We have a large amount of exposure, but again, there's no big kind of overweight that we do. So at the moment, the only sector in which there's quite a big overweight, and this is purely just because of how markets have moved, and we've seen the big tech stocks have driven market returns across the globe. See that this is the only one where we're partially overweight, but at the same time, it's only a 3% overweight in terms of the technology sector, but the rest of it is very much diversified. And so it goes a step beyond just your broad assets, how much equities, okay, where you're going to invest, into which regions, okay, now which sectors. The next step goes into, okay, we know which sectors we want to invest into, but in each sector, there's different styles. There are for the case study here, there is basically 2 different styles and then a blend in terms of the kinds of equities you can get. So the first one we're going to look at is value equities. Value equities, these are companies that you might recognize like Berkshire Hathaway, JP Morgan Chase, and Pfizer, where they have massive bank accounts, big balance sheets. They're more of your smooth, continue to perform, but don't give you any of that growth upside. So they offer you steady returns. I see this mostly in your banks, in your medical aid areas as well, and then Berkshire Hathaway, one of the big investment houses as well. But that's your value. You then move across to growth. In there, you've got multiple companies. So these are the big tech guys you would have heard a lot about: Nvidia, Tesla, Shopify. These are ones where they might not have been or have got much cash on the balance sheet. What they do is they take that money and they invest it into expansion. So with them, you're looking at probably a bit more expensive stocks, but stocks that have the potential to drive market performance, like we've seen with the names shown here. And then you get what is kind of like a bit in the middle, often referred to as quality, blend, or growth at reasonable price. These are your stocks that have a mix between the two. So a little bit of growth, a little bit of balance sheet. But again, you kind of need to blend all of these together and make sure that your portfolio is diversified, because timing any kind of shift into a growth sector or into a value sector, you open yourself up to making the wrong decisions there. And that leaves your clients exposed to potentially underperforming during a period. And so we never want to do that. So we make sure our portfolio is kind of centered around the blend. So there's a growth, there tends to be a value exposure as well to balance it out. And so the final area, and I think this is where Cinnabar believes we add the most value, being a fund of funds, is we spend a lot of time researching managers to make sure that we have, 1, the best in class fund managers, but 2, that we construct the portfolio so that, similar to how we did with the equities, where you look at a value and a growth, you do the same with managers. You find the best managers out there that are able to extract value when value runs, and you find the best managers that are able to extract growth returns when growth runs. But you need to have managers that can do a bit of everything. So they keep your portfolio more consistent than if you're just heavily weighted to one industry, and that's why we have the blend. And so in our global equity portion of the portfolio, we have the blend, which is Vanguard, so just your normal ETF, just tracks the market. We have Schroders, again, very much a tracking, like benchmark cognizant, very close to a neutral weighting, but they manage to outperform consistently by taking small little risks, never taking any massive deviations, small little risks that have proven through their strong investment history to outperform really, really well. And then portfolio metrics as well. So a name that we work very closely with, part of the investment committee, and have a really strong global offering as well. They have also a multi-manager approach, and so use the same kind of underlying logic. They make sure that the overall portfolio is very much blended. We then have two value managers, Dodge and Cox and Orbis. Orbis you might also be quite familiar with. They bring the value side of things. They've shown that they are able to consistently perform, even when value as a style hasn't potentially done too well. They've produced very strong performance numbers. And then we also have the growth part, portion of the managers, and that we've employed GQG and Bailey Gifford to manage the growth portion. And what we try to do is, through building this portfolio with these multiple levels of diversification and all the thought that goes into it, we try to build a bit of a balanced portfolio. That is my drop the mic moment, where you got defensive assets, growth assets, emerging markets, developed markets. Are we going growth? Are we going value? Are we going manager A? Are we going manager B? And what you want to do is you build a portfolio that's got this inherent level of robustness, where if you get a call wrong one way, you normally protect it on the downside. So it's very hard to bet on a specific outcome. But what we do here is kind of hedge our bets that whichever way it goes, we will not fall the most, we won't go up the most, but we lead to a smoother journey towards the end goal. Because the end goal, most funds will end at the same value. And so what that means is, once you've built this, is the level of diversification and the robustness in the portfolio comes through just looking at, this is just our top 10 stocks. Though the big names have already mentioned, but the top 100 stocks in the equity portion makes up just 30% of the portfolio. So there is a very high version of diversification here. So you're never going to be exposed to one company risk. And so it's important that we're not just diversifying because it's cool and trendy to say you're diversifying, but we're diversifying to make sure that our bets are always measured. We know exactly how the fund would perform on the back of market news that came out, and we'll be able to kind of disseminate that into performance. So that's what we've built, and proof is in the pudding. It's all good speaking a good story, but it's, can you actually deliver returns? So I mean, I'm very proud to present Cinnabar's performance. Locally, we are first quartile. So quick run through quartiles is, if you're first quartile, you are top 25% of fund managers over various periods. If you're second, you're 25 to 50. And then what we don't want to be, third quartile is fine, but what we don't want to be is in the bottom 25%. That means you taking bets that are endangering your clients, putting their retirement at risk. And so our performance of all of the funds over even the longer periods now, it's a very different team to the way it was back then, much stronger team. And we see that come through in the shorter term numbers, but long term as well, we're seeing that what we're doing now is paying dividends, and we are seeing very strong numbers on the back of that. And our most recent fund that we launched is our global equity fund. This is tracking towards the All Country World Index, one of the hardest benchmarks to beat, because that assumes you don't have to pay for investment. But as you know, there's always going to be a little fee to pay for investment. But so far, it's just over 6 months track record, or 7 months track record, it is still outperforming the benchmark. So we're very happy with the process, the decisions we're making, and really just highlights that our approach of taking small bets and making sure that we know where our risks are and how to mitigate a lot of those risks, also through our robust investment framework, is really starting to pay dividends. So we're really, really proud of the team and the investment committee that have managed to deliver these returns. And with that, I think we can hand it back over Alex, who can go through the questions.
Thanks, Cam. You know, I had a call from one of our US investors late last night, and we were just having a chat. And obviously, all the news in the US is negative about the stock market falling apart. And his words to me, I said, "How are you?" And he said, "I'm grumpy." I said, "Why are you grumpy?" He says, "Because the world's falling apart and I'm losing money." I said, "Well, the good news is not all of your money's in the US. We've got a large portion of your money in Europe and the UK, and that over the year has actually, or year to date, has actually gone up by around 10%. Obviously, the US has retreated by 3 or 4%. So the benefit of that diversification really does resonate." Jeff, there's a question here for you, and it really relates to the portfolio construction process. You spent a lot of time at Alexander Forbes. I know Adam did as well. I think you guys missed each other by just a year or so. In your experience, what is this portfolio construction process like compared to world best?
At the risk of sounding like an economist, there's no right or wrong answers, I suppose, in that, you know, there's different approaches to the way you can construct portfolios. So just, you know, in our experience, you know, obviously in many years of running the investment solutions multi-manager portfolios, which are part of Forbes, I think that we follow a very robust process, obviously within Cinnabar. But maybe to answer the two questions, there's one, you know, the principal question you have around portfolio construction, especially in the global context, is do you award mandates to a global manager that will buy stocks around the world? And you pick the 3 or 4 best global managers and or tracker funds that you might find, and you might do a core of a tracker component, which reduces your costs, but gives you the indexation core, and then you have your alpha managers that try and construct around that. Alternatively, the other route is that you have you go and try and pick the best managers in North America and in Europe and Australia and in Asia and in emerging markets. And then you have to then yourself determine what is your allocation to the different geographies. You know, and a third approach might be that you go and try and pick the best specialist managers in certain industries. So you might have energy funds and tech funds, and then you have to decide what your exposure is. I think in our construct here, we've got, I suppose, slightly the best of both worlds, in that part of the Cinnabar approach that we're taking is that we're doing a core, which is a global index core with alpha managers around that. But then we also have an allocation to portfolio metrics, which is doing something slightly different, in that they're actually trying to find the best managers in each region and then build let's say, a regional, more market, sort of country or regional neutral allocation to the various regions, but then getting excellence within that. So I suppose our goal is to try and achieve a little bit of the best of both through the approach that we've taken. So yeah, I hope that answers the question.
Yeah, that's great. Thanks, Jeff. Then Cam, I want to direct this one towards you. We've obviously built a solid group of people in the investment committee. How did you approach or think when we put that team together?
Yeah, so that investment committee is truly one of the most powerful ICs. The level of experience is you really feel it when you're in those meetings, and I think it's been put together. What you want in those meetings is you've got people that they're really at the top of the game, but they're, like Jeff mentioned, there's different ways to potentially get to the top of the game, how they built their portfolios. And what you want in those sessions is to have like robust debate where one person might say this, one person might say the complete opposite. Both may be correct at certain times, but both may also be incorrect. And so what you do is you get during these sessions, you get to the best possible outcome at the end of the day, because you've got opposing opinions that kind of guide your thinking, and it stops your company becoming part of groupthink and just everyone agreeing with one consensus. So I think bringing people in from portfolio metrics with the backgrounds like Carl potentially has with actuarial sciences, Adam's background, I think there's a lot of experience that's not just investments that kind of help with the real world decisions. So the team is, I think we showed through those performance numbers. It's really positively impacted our investment offering.
I think the other thing, just to add to that, is that the team has got different teams around them. So Jeff's got his whole team around him. Brandon's got his whole team around him. Adam has a different team. Becky's got a different team. So we're not getting that groupthink going. And that groupthink is often very destructive, because it's very easy to convince yourself that you are right, and then to convince others that that one thinking is right. By having everyone very, very separate and then coming together on a fairly regular basis, the discussion is very robust, to put it mildly. All right, there are quite a few other questions here. Back to you, Frans, and there are some more for you as well, Cam, so don't feel left out. But there's a question here about the impact of Trump's crypto reserves and what his game plan is for that, and then how it could affect us. So that is a tricky one.
Yeah, no, thanks for that one. That's nice
Yeah,
of you.
pleasure.
But I'll give you two answers. The first is I don't know what the long-term implications are. But I do think that what you've seen happening in the gold price is a very good indication of where the interest in cryptos will lie into the longer term. But I do wonder whether if you've got gold, what the advantage of crypto would be then.
There's no market. There's no market that's created, just like there's no market for gold, apart from the demand.
I mean, it's a store of wealth if you're worried about very high inflation and general chaos and pandemonium. But it's not as if there isn't an already established alternative.
And it's an alternative that Warren Buffett doesn't like, because it doesn't produce a return. And the same is true with crypto. They also don't produce a return. They are fueled by the price increase is fueled by demand. That's it.
Well, yeah, there's also the return of capital. If you think you're in an incredibly volatile environment. I mean, that's why I see crypto as a return of capital, more than anything else.
Yes.
But I wonder whether, there's this sort of these slight sort of libertarian types that have been around the crypto world forever, and I've always thought they're naive, because the ability of the state to regulate crypto and control it must be so significant that the tax authorities could very easily deal with it in a way that if you think it offers you advantages that traditional asset classes don't, you could very quickly find yourself in serious legal trouble, particularly if you end up with a lot of crypto. So I still don't. I mean, my first answer to you was I don't know. I'll stick with that answer. But if you force me to say a few things about it, they are that I'm not convinced that there is an advantage to it that cannot be accommodated by anything that's already established.
Yeah, many of our investors come to us and they have a crypto portion to their portfolio. We certainly don't manage that for them, and we're not against them having it, but we strongly recommend to have it significantly less than 5% of your total wealth. Significantly less, preferably 1 or 2. And if it ends up going 100 times value, that's wonderful. Your wealth doubles. If it becomes worth 0, it's not the end of your world.
That's exactly how we've always seen it. We've seen it as it's 1% and 2%, and you hold it there to see whether it can outcompete the 98% of what you've got. But if to go much beyond that, I don't see why you would do that and not go to something that's already established.
Yeah, it's just too dangerous. Then, Frans, there's another question here about this on the back of this delayed budget speech. Do you see South Africans leaving the sorry, not South Africans, investors leaving the market due to the budget speech being delayed, and the influence of the GNU in this?
No informed investors should be leaving because the budget speech is delayed. It's an extraordinary thing that you can't pull it off the first time, let alone the second time. What is it? Ian Fleming, who did James Bond, he said once is happenstance, twice is coincidence, but 3 times is enemy action. So hopefully we sort it out this time. No, if you've been properly informed on what to expect from South Africa's GNU, you would know that, number one, it was a very positive thing that occurred, because the alternatives could have done very real damage, the sort of damage of people who would borrow and print lots of money. So we've escaped that. You'd also further know that the deal was solid and robust, and public opinion is moderate, and so South Africa has many advantages that in doing this GNU deal that other emerging markets that went before it, got into trouble, didn't have. Countries changed peacefully or very violently. Our transition was immensely peaceful, all of which has been banked already. But you would also have known that within the ranks of the DA, there are not many people with the ability to craft the kinds of reform South Africa needs to be a high-growth economy. You saw that in the early days of the GNU, when the DA was very accommodating in terms of the ANC continuing with policies that had previously failed or would be said to continue failing. And within the ANC ranks, you have a leadership lineup that crashed their party into the ground, 40%. This was Africa's grandest liberation movement. There was absolutely no reason for it to lose last year's election. Had it in the years ahead of that election achieved modest economic growth, 2% to 3%, and the jobs that came with that, it would have been comfortably above 50%. You also sit with a business community, which I have great understanding of, that are not going to press for the kinds of reforms South Africa needs to be a 4 or 5% growth economy, because it's not their responsibility to govern a country and to take on the ideological battles that lie between the status quo and those kinds of reforms. So you would have known going into this GNU that while it was a very fortuitous thing and a very good thing, the alternative would have been very bad. That's a good way to put it. Would have been very bad. There was no immediate impetus for reform, and so we're seeing that play out at the moment. There shouldn't be too much surprise in this for anyone invested in South Africa, and therefore the reasons you were committed to the country prior to the GNU are still in play and should remain the reasons that you remain committed to the country today. The damningly confounding thing being that a country of South Africa's potential, growing its economy at 1%, takes some doing, given the natural potential. And that as the pressure ratchets up, it's easy to call the downside on South Africa. Any analyst can do it. The really difficult call is to say at what point is the inflection. We don't immediately see it on the horizon, that we just remove the policies that condemn us to a 1% growth rate. Then quite easily we refit the coal fleet, for example. We stop taxing capital on arrival. We put market value central to the Expropriation Act when it comes to the question of compensation. Those 3 steps on their own take the growth rate to 3 or 4% in a very short period of time. And then the bet on South Africa plays off very handsomely for anyone who's stuck through it.
There's a question here on that growth rate, and it's about the sectors that are likely to propel or assist South African growth to achieve the 4% year-on-year level.
Well,
what are the standout ones for you?
It's hard to say, and I think one of the answers I tend to give is that if you are a sort of state industrial planner, you could give a very good answer to this. But if you're not, then you would say that where you create an environment that is competitive for any investment to take hold, it will be the collective scheme of things, and then behind that the thousands of little guys who realize that there are opportunities here to create little entrepreneurial businesses that pull employment out of the doldrums that it's in at the moment. So simply create a competitive environment to invest in, and then whatever is the thing of the day will grab hold of your economy. In South Africa, the infrastructure is an absolutely massive opportunity and build. Energy, massive opportunity and build opportunity. Mining, we haven't sunk a new shaft in South Africa. Maybe there are 1 or 2. I tend to say there hasn't been one, and then I don't check for a few years. For 10 years. And the potential of agriculture is absolutely immense if you commit the capital necessary to irrigate more broadly, which very few people are prepared to do because of the threat of expropriation. So, and oil and gas off the west coast. I mean, that oil find in Namibia certainly extends into South Africa's waters. But we have hounded.
They don't just stop the deposits where the boundaries are.
But it's not a question of picking a sector and then how can we advantage the sector? We tax capital on arrival in the country's economy, as Starlink makes the point of. That makes you fundamentally uncompetitive.
Right.
We do not have enough electricity to support much by way of future growth because we haven't refit the coal fleet. And we threaten fixed investment on the question of property rights, which are weaker here than in almost any major competing emerging market now. As long as those factors are remaining in place, we will not lift the fixed investment rate, and you won't lift the growth rate. And the rest of the story writes itself.
I was with someone last night, one of our clients who actually builds mines, and they were saying that if they had set up a mine, they would happily set one up north of the Limpopo, but not within South Africa, just because of the political risks that go along with establishing a mine here. How do we mitigate against, are those risks going to reduce, or is there no reduction on the horizon?
Well, not on the immediate horizon, but it's just the same point. The three things to do: stop taxing capital on arrival. You shouldn't tax it when it leaves your economy. It's not when it tries to come in. Stop doing it. And then that's step one. Step two is refit the coal fleet. We produce 28,000 megawatts, peak day at the moment 26,000. For us to maintain a growth rate of 5% through the next 10 years, we need to double that within a decade.
Yes.
You can do that easily because there's enough defunct coal capacity that's open. And you can tag team this with the Americans. They will support you, and they'll batter the Europeans when they get difficult about our exports and the carbon content of the exports. And the third thing to do is you cannot raise a question about property rights. And the press might misreport this, and sociology professors at a university might tell you the erosion of property rights brings about social justice. But when a client comes to see me to do their due diligence on South Africa and they ask about property rights, they do actually read the Act.
Okay.
And they see that anything we have in SA can be taken for less than its market value. You know, if you invest in emerging markets, there's swings and roundabouts, you take risks. But the collective of trying to invest in SA is just that it cannot draw the capital. And so the fixed investment rate's at 15%, the emerging market average is 25% and higher. But it's these things, I don't know if dwelling on this, it's very important. These are the easiest things to shift.
Yeah.
Because public opinion, as I demonstrated to you, does not demand any of this. And it's a simple question of shifting three little things. And you position South Africa to, in the medium term, ramp its growth rate up to 4%. And, I mean, that's the call we're trying to get right for our clients, is ahead of time. Is that moment nearby, and when is it, so you can time it correctly? And if you do so, you will make a lot of money on South Africa.
Do you feel it's nearby?
Not at the moment, no. But the pressure is immense. I can tell you privately, the discussions you have with politicians are more encouraging than they were before. You can openly say in a meeting of senior people that if you try and tax capital on arrival, you will be done. It is over for you. It's the end. Your support will fall to under 20%, and you will become a party that people only remember. And then there is at that point now a serious exchange about what are the alternatives. Now, I can assure you that 10 or 15 years ago,
The case.
it wasn't even, the topic couldn't even be raised because it wasn't an issue and there wasn't a threat to them. So I don't see it shifting in the immediate future, but if it is to shift, the kinds of circumstances that are now coalescing are those that will shift
it. Frans, we speak to quite a few estate agents just to get their sense as to what the movement of people looks like. And we're getting the sense that that quite a few people seem to be moving back to South Africa from abroad. We're also getting the sense that quite a few people are moving back to Johannesburg. But Gauteng still remains a bit of a disaster. I mean, potholes everywhere, water gushing out of pipes, left, right, and center, robots out of order. What's your sense on those few metrics?
Yeah, look, the Western Cape's a win, however you position on it. If the north of South Africa fails, the dump of skills and capital onto the Western Cape will just rise even faster than it has already. If the rest of South Africa succeeds, the advantages the Western Cape already has will simply be exacerbated. So the Western Cape is one of the world's most exciting emerging markets of the next 30 or 40 years, and it's going to remain that, and you can commit to it, and you're going to do well there. A more difficult bet is the north of the country and Gauteng. It's cheap relative to the Western Cape, which means that if South Africa does come right in the greater sense, makes these reforms, fixed investment to 25%, if you'd bought into Gauteng, or whatever that means, bought into it ahead of time, you're going to do exceptionally well there. The return of the middle classes is interesting, but not unexpected, because they increasingly come to understand that if South Africa fails, the macro, the union, only 110 years old, the country it balkanizes in one respect, that it becomes an enclave society. And the middle classes, from the sort of moderate middle classes up to the wealthier ones, will be able to live in gated communities forever. And within those gated communities, I mean, you see these sort of Gulf estates, lifestyle estates being sort of built down the coast from Plett towards Cape Town. They're essentially independent. The people within them can externalize their wealth, so they start to think in terms of the dollar. They can work for clients all around the world, sitting in their studies, and do that. Their kids will be highly mobile, and can move around the world, and that South Africa offers them a very attractive lifestyle, and it's just cheaper to go to dinner than is the case now in London or Washington or New York. And so I think that you could continue to see even if South Africa, macro South Africa, performs not that well, you could continue to see a return of people, because they realize that it's perfectly feasible to maintain a very high lifestyle inside a private estate, where that estate has taken back what were once the functions of the state. And if South Africa doesn't perform as well as other emerging markets, I've got little doubt that over the next 20 or 30 years, a very pronounced, increasingly pronounced feature of the country is going to be that it retained its middle classes to a greater extent than other emerging markets that went through difficult times ahead of it had, as a consequence of the ability to establish. A friend of mine calls them citadels. The citadels in which remember, very small, 861,000 taxpayers, income taxpayers on earnings of over 750,000.
I know, it's quite frightening.
Yeah.
Quite frightening. But on that note, I think it's a wonderful time to call the quarterly, and it really speaks to live where you want to live, but make sure your capital is well diversified, preferably abroad, and obviously have allocation here. But if you have dollar wealth, you're more likely to be okay anywhere in the world. Frans, thanks so much for joining us. Your insights were phenomenal. We really look forward to having you back again. And this boring year is not going to be a boring year. Cameron, well done. Jeff, thanks for joining us, and thanks to all of our attendees for joining our first quarterly session. We're really looking forward to hosting you next quarter. Bye for now.